welcome everyone to our another insightful session of the Wealth Builders Masterclasses. So today I'm really honored because I have to host someone who's really I don't know, dear to my heart. Tyson, he was at my conference too, and I love the way he has built wealth for himself. He's a semi-retired orthopedic surgeon with over 40 years of investing experience and a remarkable $2 billion real estate portfolio spanning multifamily, triple net, self storage, oil and gas, hotels, and many more. So he is living example of how precision and discipline from one profession can powerfully apply to another. So welcome, Dr. Cobb. Such a pleasure to have you with us today.
Thank you. It's a pleasure to be here. Thanks for the invitation.
Of course. And today we have a very interesting topic. Our topic is the science of wealth. We all know, right? Life goals is either art or science. So we're gonna be learning the science about the science of wealth today. It's gonna be from surgeon's viewpoint, a surgeon's data-driven path to $2 billion real estate portfolio. So before we get started, I'm gonna go through a small little disclaimer. So this session is for knowledge sharing purposes only and should not be considered as a legal accounting or investment advice. And this session does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. So if you have any investment related questions or any legal questions, please reach out to the appropriate parties like your CPAs, your attorneys, and some housekeeping items. Please use the Q&A box if you have any questions, and we'll try to answer all your questions live. If we can get to your question, excuse me, please email me at winky@loombainvest.com and we'll surely respond to you. So, Dr. Tyson Cobb, do you have a presentation for us today?
No, I was just told to come with the Q&A, so
Okay.
I didn't prepare anything, but I can certainly pull something up because I have plenty available. So it's totally up to you, however you prefer to
No,
do it.
that's fine. We love Q&A too because I think we can dig deep that way, that'd be super awesome. So, can you take us through your journey, from the orthopedic surgery to large scale real estate investing? I mean, that's really fascinating. So maybe you can take us through that and let us, experience that with you.
Yeah. Yeah, so I was your typical busy orthopedic surgeon. Woke up one day with the proverbial golden handcuffs on, had no control over my time. If I didn't show up to work and see patients and do surgery, the income stopped. And it's a very demanding lifestyle, on call, and just constantly trying to find a little free time here and there. And that's the life of a busy orthopedic surgeon. Um, on the revenue side of it, you make a lot of money, but it's taxed very highly, and it's tough to mitigate taxes in that environment. It's even tougher if you're dealing with your average CPA, because most of the CPAs do not help with respect to planning. They just simply do your taxes and tell you how big a check to write. And my CPA used to tell me not to complain about the big checks to the IRS because it just meant I was making a lot of money.
Mm-hmm.
I should have fired him on the spot, but I wasn't smart enough to back then. There was a lot I didn't know. And I think that's one of the truths in life is, you don't really know what you don't know. And so part of my journey is joining a lot of masterminds, and that really unveils what you don't know when you get in a room with a bunch of people that do know, right? And so that's helped a lot. I think the saying, if you want to get somewhere, find somebody else that's already there, and learn from them. And that's the fastest and the least expensive, regardless of what it costs you. I was watching Alex Hermosi YouTube recently, and he was talking about how he paid somebody that was ahead of where he was on his journey in business $120,000 for 4 phone calls. And while that sounds like a lot, the boost that he was able to get from someone who just looked at what he was doing and knew immediately how to fix that, he could have spent the rest of his life and never actually made that transition. And I think that's just one of many examples that happen with people that that either get involved in a mastermind or by some mechanism reach out and learn from people that have already solved the issue. So when I went into real estate and backed off, I left my group and dropped back to 1 day a week. I was expecting my income to drop, and it actually went the other direction quite drastically. So, I map all of that out on a graph and some of the presentations, but I can kind of give you the highlights of it. With the orthopedic surgery, the slope was about like this. It was a steady uptick, but it wasn't anything exciting because I was, paying half of what I made in taxes, and you have a little bit of lifestyle creep. So as your money goes up, so do your spendings. And if you don't have the mindset of the wealthy to control that and invest, lifestyle creep will eat up a lot of what the IRS doesn't. But between the two, uh,
Mm-hmm.
your wealth accumulation can be quite slow, even though you're a very high income earner. When I left my group and dropped back to 1 day a week, it allowed me to spend time reading books, joining podcasts like this, where you listen to other people and figure out that you've been going down a bad path, and learned how to mitigate taxes. Found myself in groups with people that could recommend people that were just a lot smarter than the people that I had been hiring. And so, my wealth growth at that point basically turned up about like this. And then later I went into syndications that even turned up even more. So when you get into syndications as a limited partner investment, you're able to do multiple of these over and over and over again. And as a passive investor, your responsibilities are small. So you can just keep adding these on. There's no limit or no ceiling to what you can do. Whereas, if you're just buying your own real estate, and I'm not discouraging that, I'm just comparing and contrasting so people can understand because I think I've done all of it to some extent. When you're doing your own real estate investing, while that's a lot of fun, it's also time consuming and you can only do so much. So you do hit a glass ceiling there, just like the surgeons do. It's not as bad as being a surgeon for sure, because you do have your own time. You can decide when you're going to show up and when you're not. And you can get other people to help you with that. Where as a surgeon, not so much. I mean, the patients aren't going to tolerate me hiring somebody else to come in and operate on them, right? So, but as a real estate owner, you can do that. So there's ways to get your time back, but certainly it's not as simple as investing as a limited partner. Which if you're a high income professional, you're in a position where you can do that. If you're not, then you need to choose a different path. But the other thing that I love about syndications is you're leveraging the expertise of people who are experts. We're
Experts.
we're joining people who do this for a living. This isn't Uncle Bob taking his first run at a multifamily that he found down the street, right? You can expect bad outcomes with those types of things. I
Mm-hmm.
talk to investors all the time. Oh, I tried that multifamily, it doesn't work. Okay, well, tell me about the investment you got into. Who was the team? How did you vet them? And most of the time, and I'm guilty of it myself years ago, they're not vetted at all. It's like the first opportunity I saw, so I put $100,000 in it and lost it all. Well, that's not surprising that you had that outcome if that was the way that you vetted the deal, right? So, that's part of being in the masterminds where you learn from people that have been down that path and had that bad experience, and now you can learn from them and save that 100,000. So people complain about spending 10 or 20 or 30 or 40 or $50,000 on a mastermind, but the reality is, if you're applying that information and
Whatever you learn.
knowledge, you get that back many fold. Just in tax savings alone for high income professionals, it's just crazy the amount of money that those people are leaving on the table because they've never been taught any other alternatives. So I'll stop there and let you ask questions. I
Yeah.
kind
Oh my
of.
God. Oh gosh, you gave me so much in such a short time. I have lots and lots of questions, but I wanted to first ask you. I'm going to start with this question. Is like you coming from the medical profession, coming from medicine, and why real estate? And my daughter, she's a physician too, but when I talk to her about real estate, she's like, Mom, no. So I wanted to hear your mindset, what was the triggering point? You did mention the taxes because you guys are high income earners, and then you look for my tax bracket. But the thing is, the depreciation that you're getting on the real estate side and not being a real estate professional, there is a limit what you can use. It's basically for the long-term capital gain that you can offset against your losses that you're getting through the K1. So if you can take us through that journey and then you also mentioned that, getting on the GP side and leveraging others' knowledge, other skill set is much more important and helpful to you when you're stepping into something out of your comfort zone because you're thinking outside the box, being a surgeon, already making so much money. And then you think like, oh, why real estate? So share with me.
Yeah. So I actually started real estate very young, investing in land. So I grew up on a ranch and farm in Texas, and I've been and continued to invest in that type of property for for virtually all my life. So I was already a little bit familiar with it. And then, for sure, the tax advantages are substantial. You mentioned real estate professional. So when I left my group and dropped back to 1 day a week, it allowed me to get, jump in with both feet, buy my own properties, manage them myself, and become a real estate professional. And so, that's the easiest way to mitigate taxes. There are other levers that you can pull if you're not a real estate professional and you're not working part-time. But one of the things that that I tell physicians that are nearing retirement, it's actually quite fun to drop back to 1 day a week so that you still get to practice your trade and you can qualify as a real estate professional. And I just enjoy investing in real estate. I think it's fun. I love joining teams. I love all the entrepreneurs that I get to hang out with now. And quite frankly, that's who we do life with now is, all of these different partners that we've partnered with all over the country. And it's been a fun ride. I'm very passionate about it. And I love doing it. It's what makes me bounce out of bed in the morning and, go hard all day. I just enjoy doing it.
That's really good. And that's, kind of cross-pollination right there. I come from the IT world, and then you come from the medicine world, and we both are in real estate, right? So this is cross-pollination coming from the different fields, and then you see the opportunities, not just you are coming, you're making a difference in other lives around you too. You're educating other people in your field where you're coming from. So how was that journey for you? Talk to us about that.
Yeah. So you mean the educational aspect?
Yes, because I'm pretty
Yeah.
sure you brought multiple physicians or doctors alongside you into the real
Yeah.
estate journey, right?
Yeah, so I mean, let me back all the way up. I mean, when I first started, I was completely clueless. So I
Mm-hmm.
would listen to podcasts and I literally was Googling terms left and right, just trying to figure out what you guys were talking about, right? Because it was
Mm-hmm.
all, over the top of my head. I speak a different language in orthopedic surgery, so, we frequently have to try to kind of dumb that down for patients so that it makes sense.
Mm-hmm.
But when you get on these real estate podcasts or go into these meetings, they're using terminology that I'm not familiar with or I wasn't at the time. So
Mm-hmm.
that was, it probably took me a year to get comfortable with, all the ins and outs. And I, took a number of courses and read a ton of books and listened to a lot of podcasts and just started hanging out with people that were doing it on a daily basis. And so, over time, we started to build a bit of a network of orthopedic surgeons that were investing together. And then I started Timberview Capital, and that basically just, created some structure and organization around that network. And so, yeah, we do a ton of educational. We bring CPAs in and talk about a lot of different levers that people can pull, and all of the different investors are in a different situation depending on how things are structured. And most of them have no idea how to even unwrap that because their CPAs frequently don't educate them in that regard. So, we teach them what to look for and how to unwrap it and figure out how to, work, what can they do to mitigate the taxes. I mean, obviously it's, fallen into the passive and non-passive buckets. And so a lot of what we do in real estate can be utilized very easily to offset um, the passive income that comes from surgery center ownership or imaging center ownership or those types of ventures that many physicians get involved in. And so, some of those little pearls that you give to your investors are saving them hundreds of thousands of dollars in taxes every year. And, I have no idea why their CPA never, enlightened them. But the reality is, most CPAs just don't know a lot about real estate and depreciation and tax mitigation, which is kind of mind-boggling to me. But that's what I see on a daily basis talking to investors.
Great. So let me ask you this question. What mindset shifts were necessary to make this leap with confidence for you? Basically, it's a huge leap.
Yeah. Yeah, so that's a fantastic point, and I'm actually just my book launches starts tomorrow.
Oh,
So I
awesome.
wrote a book called
Congratulations.
Wealth by Design. You can find it on Amazon for 99 cents this weekend. So it's a special 99 cent promotional sale, Wealth by Design, and that's the first concept in my book is the belief. You have to have the mindset. So my mindset as a busy orthopedic surgeon was I don't know anything about taxes. I don't know anything about investing. I'm going to leave my investing to my financial advisor, with the exception of my land investments. And I'm going to allow my CPA to do whatever he thinks needs to happen for tax mitigation, which was almost nothing, quite frankly. But they would send you some kind of little tidbit of information about setting money aside for the kids' college and a little of this and the 401 and, things that really don't move the needle very much. And so a lot of the big items that people in the know use and the wealthy elite know for whatever reason just seems to escape most of the population. But yeah, so the mindset, first of all, nobody knows more or is more concerned about your wealth growth than you. So
Yes.
to hand that off to somebody else who's so busy they don't know which end's up, right? These CPAs are just running through tax return after tax return after tax return. They're not worried about how you're planning your year out, right? They're going to send you your return, and if yours is like mine, it comes literally the last minute, so you don't even have time to think about anything other than to sign it and write a check to the IRS. So you want a consultant that's going to be with you throughout the year, helping direct that. And if you're in groups, uh, like our network, we have a lot of different people in there that know a lot about different things. And that, as we mentioned earlier, that's how you learn. But, I think the mindset of taking control of that was exceedingly important for me, because I had always handed that off. So when I reached the point from listening to podcasts just like this, where you're like, wow, had no idea. So now you start reading and you start digging in and you reach out to people, and you start learning some levers that you can pull, and you just educate yourself. And it's not like I'm doing all this on my own. I still have a CPA who's overseeing everything I do to make sure that all the T's are crossed, I's are dotted. The difference is I have a pretty good idea what I'm going to do to mitigate all or almost all of my taxes this year. And then I have him help me so that I do that correctly. So everything's documented correctly, or my business is set up appropriately, or they structured appropriately, because that's the underlying thing that we don't know. So being in the groups, having the right mindset, just sets the stage for having a different life. I think one of the sayings that you hear is if you want to change your tax, then you need to change your facts, which means, if you need to structure a business differently so that it's taxed at a better level, that's what you need to do. And if you do find yourself in a position where you could qualify for a real estate professional, which requires over 750 hours a year and more than anything else that you're doing, then you structure it that way. If it doesn't work for you, maybe it works for your spouse. So if you're filing jointly, you don't need to do it. Your spouse can do that. So a lot of our investors have spouses that are stay-at-home moms, and now the kids are old enough that they have time to be the person that qualifies for that, and makes a huge difference in your wealth growth when you start truly mitigating your taxes. I'll stop there and let you key in.
Yeah, you raised a very good point, and I wanted to highlight that, how you said you need to be in charge, you need to be on the driver's seat all the time to see what's going on, whether it's your investments, your taxes, your work, whether you're a physician, IT person, whatever you're doing, or if you're working with a CPA, even if you're working with the attorneys, you got to know your own story. A lot of times people get so messed up when it comes to delegation. They feel like, oh, I delegated to somebody and that's it. I wash my hands. I'm going to let them take care of everything, right? So what
Yeah,
happens? For example, even the marketing company, we hire somebody and say, I hired this person, I'm paying them $4,000 a month, they're gonna do everything for me. And guess what? 6 months down the road, you're gonna think, oh my God, I wasted $10,000. Nothing happened. Nothing happened because you were not there, you were not involved.
right.
Because it's a very important point that you have raised that, even you delegate in a way that you're in the driver's seat and you have the holistic view what's happening where, so you have the control over everything. And I love that, how you did that. And then you got to the $2 billion portfolio, which is amazing. I'm going to ask you about that. But first, since you brought up your book, and the book is Wealth by Design. So how did you come about that? What made you think that I should write a book for real estate versus medicine? Tell us your thought process there.
Yeah, so I mean, there's just so many high income professionals out there, just like me, that don't know what they don't know. And I just wanted to put it all together in one spot, not to recreate what other people have done, but rather to just design a path uh, for people that are in that position to know what levers can be pulled and how much they can change their wealth growth. So most orthopedic surgeons are, basically handing all of their tax mitigation over to their CPA. Their financial planners doing a lot of, if not all of their wealth decisions. And, you know, it's just amazing how far you can get in life and how much money you can waste before you find out simple things like the vast majority of financial planners have to sell the products that their parent company tell them to sell. And I never really realized that. I always assumed that they, basically had carte blanche decision making on, where I should be putting my money, but that's not the fact at all. The fact is they have to sell what their parent company has for them to sell. So they're very limited. Most of them are as far as what they can get into. If you look at Tony Robbins' research, he studied a 35-year period starting in I think '86 and looked at the difference between the wealth growth in the stock market versus private investments. And it was more than a 5-to-1 difference
Mhm.
between those two in favor of private investments. So people talk about, the risk, and there are risks. They don't all do well. Some of your real estate deals are going to do poorly and you're going to lose money. That's okay.
That's true.
They don't have to all do well because when you look at a 5-to-1 and when I mentioned the my wealth growth earlier from just slightly uptick to just turning up and dramatically going up with real estate involvement. Sometimes people are like, yeah, that's kind of a one-off. That's probably not reproducible, or that's, too good to be true. And the reality is, Tony studied this, did the research on it, and basically provides the math behind the change that you see in the graph of my net worth growth before and after real estate. And so it was very interesting to me. And it was just kind of a fluke. I was actually, my bank reached out and wanted an updated personal financial statement. So I go into my computer and I'm trying to find last year so I can update it. And I'm looking at all these different personal financial statements, all saved by personal financial statement in the different years. And I thought, I know that real estate has made a remarkable difference in how fast my net worth has grown, but I had no way of putting, an objective assessment on that. And I'm like, I'm just going to graph that. So I went back and I had a 5 year period when I was working full time as an orthopedic surgeon. And then I carried it through my real estate career. And I mean, it was just crazy how much, it sloped up when I went into, the first upslope was in the real estate. The second upslope was into syndications. And then when I found Tony Robbins' research, it was kind of relieving, to be honest with you, because as you talk to people and you just have your experience, and they're like, yeah, it's probably just a one-off deal, fluke. It's probably not reproducible. And at that point, I had no context of whether or not that could be a true statement or not. I'm like, well, I don't know what to tell you. It's just been my experience. Maybe you're right. Maybe it is just a fluke experience. And then I found Tony Robbins' research, and I actually looked at the difference in the slope of the
Correlation.
line, and it basically explained
Mhm.
the difference exactly. And I'm like, this is really cool. This was my experience. Is exactly what Tony Robbins found. So anyway, that was my experience. And once people hear that, it's obviously very interesting to them because it's some or all of which could be, imported into their lives should they choose to do it. So I just kind of basically sat down and tried to come up with a step-by-step approach on how to do what I did, based on, what I did and my experience. And then, we've put together Timberview Capital, which is, a network of people investing together, and we, have an educational platform there and do webinars on a frequent basis. Some of which are deal related, but a lot of them are educational as well. So it's been a fun process. It's like anything else in life. When you discover something that's just life changing, you want to tell other people about it, and it's just fun watching it change their lives as well. So it's been a fun role for not only for myself but for our entire network.
Others around you.
Um,
Yeah, I think it's very rewarding when you see others getting the similar benefit. So coming back to your book, Wealth by Design, what else is there? I mean, from your experience, did you figure out that you gotta have a certain kind of mindset, or you need to wear certain kind of hat, I would say, to have that holistic view where you're going and boom, 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 connecting the dots? Because what I hear from your story is you did it yourself. You got to the $2 billion portfolio, then you look back, you say, okay, I'm connecting all the dots. Like Steve Jobs, he said that too, in one of his speeches, that you cannot connect the dots in future, but you can always look back and you can connect the dots. And those dots might help you to figure out what is gonna be in the future. And I think maybe that's what the gist of your book is. I never read your book so far because it just came out, but I just wanted to hear from you, from your experience, or what would you recommend to the listeners?
Yeah, no, you're exactly right. I mean, it's connecting the dots, and that's exactly what I did with the book. It starts with a mindset. I mean, everything starts with mindset. It doesn't matter
Exactly.
whether you're going to improve your relationship with your significant other, or whether you're going to get in shape, or whether you're going to turn your wealth growth around, or whatever. And there's a lot of levers. So, just take getting into shape, for instance. Joining a gym is important, but it's not going to solve all your problems, right? But it might be the first step. Probably the first step is actually getting the mindset, because if you're not committed to do it, nothing's going to happen. Joining the gym is not going to change anything. It's going to make you feel better for a little bit because you feel like you've actually taken a step. But the reality is you have to figure out how to get into that discipline mode of getting up every day and going to the gym and doing the reps. And wealth growth is the same way. It's just a disciplined approach to just getting up and moving it just a little further in the right, needle a little further in the right direction every day. And then all of those little steps build up over time, and you'll be amazed at how far you can move in just a few years.
That's so amazing. Oh my God. Congratulations
Thank
first
you.
on your book, and then also sharing this wealth of knowledge with the world, I would say, not just the real estate professionals here, but with everybody whosoever done this before or looking to do something like that or feeling like they are trapped. They cannot think outside the box, that's going to give them some vision or something to look forward to. So now take us through your journey. How did you get to the $2 billion portfolio, which is like amazing. It's 2 billion with B, not
Yeah,
million.
so just to be clear, they're not under my management. So I've been invested in that amount with various partners. But part of it was joining. We talked about the mindset. The two other kind of early steps that I think are important are joining networks or groups, and then obviously you have to educate yourself. So reading books, and I think everybody kind of has the same excuse for not educating themselves. First of all, it's the mindset of, hey, I'm an orthopedic surgeon, or I'm the dentist, or I'm whatever. I'm going to leave that to the professionals. But as we talked about before, it's very important that you're behind the wheel. It's okay to have your financial advisor advising you from the right seat, but you need to be in the driver's seat. And same thing with your tax. I mean, you want your CPA. I mean, I just met with my CPA yesterday, and one of the things we discussed is, do we want to change the structure of this business so I don't have to pay so much in self-employment taxes? And we actually went through the whole math, and just the way things are structured right now, it really wasn't going to change that much. So we chose not to do it. But those are the kind of things that you need their help for, unless you really know a lot, which I feel like I know more than most professionals out there, but not enough to drive without a navigator. So, I'm still driving the bus of my financial growth, but I do have a lot of people in a navigator seat over there, and some of those are people from the network that have been through it already, where you can just reach out. I tell people I can solve almost any problem in business right now, not on my own, but I know people
That's
that I
true.
can
Being
call.
resourceful, right?
Yes.
That's what really matters in life, no matter where you are, what profession you are. As long as you're resourceful, you know how to get the job done. And that's
Right.
what's going to move the needle. Because a lot of time people think, I need to know this, I need to know this, before I can fully step into something bigger and better, because they're holding themselves back. So you just have to let go and then figure out the people who can do it and partner with them, collaborate
Right.
with them. That's what you
Yep.
did, which is
Yep.
awesome.
100%. And it'll move you along so much faster by
Mhm,
joining networks and
mhm,
groups. So, I think those are, kind of the top three relative to just, getting started. And then you have to take action. So, you've changed your mindset so that you're in charge of your life now.
mhm,
You've joined some groups, so you have people that you can reach out to and that can advise you and help you, and find the right people. So yes, you need a CPA in the navigator seat, but not any CPA. It has to be one who actually understands how to advise you and has that
mhm,
mindset. So if they don't have that consulting mindset as an advisor, um, you're not going to get to where you're going. Now, that doesn't mean that you can't have your same CPA, because I actually still use a different CPA other than the one I met with yesterday. So I have one who's filing my taxes, and I have another one who I use it for consulting purposes. So between the two of them, we can solve almost any problem.
mhm.
And if there's a problem beyond that, I'm in groups that I can reach out to so we can solve the other issues, which are not many, frankly. So, once you get, past those issues, so you've changed your mindset, You've got your network, you have your knowledge now because you're reading the books, and I got diverted there. So let me drop back on that. A lot of people don't make these moves because they feel like they don't have time, but there's a ton of time that we're not utilizing. So I started listening to audiobooks when I would drive. I started listening to audiobooks when I was at the gym working out. Started listening to audiobooks, anytime I had any downtime because I just reached a point where I'm like, okay, I'm committed to learn all this stuff and get better at it. And time utilization will help you get that education and understanding so that you're comfortable. And the reality is, you'll never be completely comfortable. I'm uncomfortable all the time. If I wasn't scared to death at times, I probably would get bored with this. But as you just get into bigger and bigger deals, you're always kind of in an area where you're a little unsure because now you've moved to another area, another asset class. And to me, that's exciting. For other people, it's just completely terrifying. But either way, you're going to be uncomfortable. So I tell people, just get comfortable being uncomfortable. It's okay. That's how you
Yeah,
grow.
I agree on that.
That's
I
where
agree on
you
that
grow.
100%. Yeah.
So you have
I
to
think
take
it's,
action. I'm sorry,
yeah,
go ahead.
yeah, I think you said it very well. Just get comfortable with being uncomfortable because I think if you're not uncomfortable, something is wrong. That's the way I look at it. Because
Right,
if you're uncomfortable, you're hesitant, you're scared, you're fearful, you'll do very well because you go beyond the limits to figure out what could go wrong. Let me fix that, right? Or just
right.
let me have the solution ready because you cannot like bulletproof anything. There's always risk. So you need to figure out what mitigation strategies I should have in place in case something goes wrong. So being uncomfortable can make you do that.
Yeah.
Thank you for sharing that. So there is a question in the audience. I'm going to ask that first as well as we move along. So Kim is asking, do you syndicate deals? And I think answer is yes, right?
Yes. Mhm.
Okay, so Anthony is asking, I'm also a healthcare professional with reps. My biggest issue is deal flow and scale. Seems I have to keep properties close to where I live, hard market in Northeast. I see you have properties in many areas of US. Are you vertically integrated? How do you manage that large spread out network?
Yeah, so those are all good questions. I mean, even when I was managing my own properties, I still managed to do them from a distance. And so you have to have things set up so that that works. Um, at that phase of my life, I was doing a lot of triple net. So triple net is not as hands-on, so you can manage from a distance fairly effectively. So I think that if you want to be able to do the long-term management and you don't have partners, that would be a good place to start. Start with triple net because most of your work's up front with vetting the tenant and getting everything set up, and then it's fairly simple thereafter. I mean, when you join groups and you have partners, then I just set things up so that I don't have to be there all the time. So yes, we'll go on site and we'll do things, but if the if the partnership is set up in such a way that I need to be there all the time, I don't get into those deals.
Mhm.
So if I don't feel comfortable with the boots on the ground and the way things are set up, I stay out of those deals. But it's quite easy to find good partners that can handle that, and I don't have to be around that frequently. And you go out enough so that you feel comfortable with it. I love working with groups that are vertically integrated. I think that's the best way to go if you can. But we make it work in quite a few deals without being vertically integrated. So you can do it either way. But I think vertically integrated is the way to go if you have the bandwidth to do it. I mean, you have to do it well, obviously. So if you have the time, patience, and team to do that, I think that's by far the best way to go.
Thank you. You said it's easy to find the right partners, but I hear all the time people say it's very hard to find the right partners. But you said it's easy for you. So share your strategy with us. How did you find the right partners and what makes you think it's easy to find the right partners?
Well, the easiest way to find great partners is to find bad partners. Because once you've been through that, they're pretty easy to recognize, right? You just have
Mhm,
to do a good job of vetting them because success leaves clues, and so does bad judgments. And so you obviously don't want to do deals with partners with bad judgment, but people with bad judgment tend to have bad judgment throughout their life, and they leave a
mhm,
trail of tears. So you just simply have to dig in and do your research. I did a ton of research as orthopedic surgeon, and I just use those same skills to research teams and research investment opportunities. And that's one of the things that I think one of the mistakes that I see a lot of professionals making. They just jump in the first deal that comes along, and they don't really know how to vet them, and it winds up in disaster a lot of times, probably more often than not. So, we probably go into, less than 5% of the deals that we look at. So anytime I'm looking at a deal, my first question is, why do I not want to do this deal? And the answer is always right there, or almost always right there. It's the one where you can't find a reason that you don't want to do it, then it's a good deal. They all have sound partners. They've got a great track record. Their LPs have done wonderfully well in the past. They either haven't had capital calls or not many capital calls. They seem to do a great job of management. Their reviews are good. Their investors have nothing bad to say about them. Their property has a lot of meat on the bone. There's a ton of upside. It's not going to be a terribly difficult lift. There's not a lot of risk that can't be mitigated. When you just go through all, it's in a great area, fantastic job growth, fantastic population growth, low crime. You just look for all of those things that you want to have in an investment opportunity. And when you just check all of those boxes off all the way across, that's a deal to get in. Unfortunately, 95% of them don't work, you know.
don't check all the boxes.
Yeah,
What,
exactly.
actually, I did have this question for you in my mind, that because since you're data driven and coming from the orthopedic world, or I would say medicine world, so I wanted to ask you, how do you do your due diligence, or what metrics or indicators that you use? And you already laid that out. Thank you so much. You're reading my mind actually today. So let me ask you this question. You've been investing for over 4 decades, which means you have witnessed multiple economic cycles. How did those cycles shape your approach to diversification and risk management across different asset classes? Because you are pretty diversified. I see you have multiple asset classes under your belt.
Yeah, so I'm just a very strong proponent of diversification, and as I mentioned earlier, as you move into asset classes that you haven't dealt with before, you're going to be a little uncomfortable, and it takes some research, and you have to spend some time
Mhm,
sorting that out so that you can figure out what boxes and what red flags you're looking
mhm,
for, right? Uh,
mhm,
but the ability to pivot and move as the market cycles change. We just went through one cycle where the Feds ran things up, and for the multifamily sector, they also were simultaneously hit with a surplus of new product coming to the market. So not in all areas, but in some areas, they're struggling quite a bit right now. But that's creating a lot of opportunity. So I was listening to a podcast recently, and they were asking, what would you have done differently? And, both of them agreed that they would have bought more property back in '08 and '09 when everything was on sale, but nobody was buying because there was so much blood in the streets. People were running
right.
for the hills, right? And it's not that bad now, but it is kind of that bad in some areas. And the reality is, spring's coming back, the sunshine's gonna be here again, and life's gonna be good at some point in time in the future. You just have to make sure that you make really wise choices on what you buy. So, when you're buying in a down market, it's not just about, okay, it's all on sale and it's all great. No, it's
I
never that way. Everything has to be vetted very carefully. And if you're going into syndications, you want to bet the team probably as much as you do anything else, because your team is going to make you or break you. So if a bad team can ruin a great deal, and a great team can turn around some things that other teams can't turn around because they just don't have the ability, the background, and the knowledge, and the employees that are capable of making all that happen. So, yeah, I think vetting deals and teams is probably one of the most important skill sets that you can develop, and the mindset of just kind of throwing on the brakes and realizing that I don't care how shiny it looks, you just have to dig in. And if
That's true.
there's a
Mhm.
red flag in there, just don't do bad deals. Just don't do it. Walk away
That's
from
true.
looking.
And I think that all comes with experience, because
Oh, for
the
sure.
multiple deals you're gonna do yourself, hands-on, you will know, who's who, who's what kind of thing. You're gonna start seeing through people, how trustworthy they are, how transparent they are. I think that's the most important thing in this world, the transparency. A lot of people, they will hide stuff, or they'll just, like you use the word shiny object. They make it like very nice and pretty and kind of precise, but you need to dig a little bit deeper to figure out what exactly it is. But when you find the right partners, there's nothing like that. Then you have to trust them somewhere, somehow. And I just feel blessed when I find the right partners. I'm like, okay, I'm gonna stick with them for a long time now. It's very hard to find the right partners. I'm going to tell you that, because it's not like that anybody's bad. Nobody's bad in this world. But the thing is, some people, they have the mentality, they think, oh, they can do it everything themselves. And then they're going to show you everything, not the underwriting completely. Maybe they'll hide the rent rolls or the T12 or whatever. They'll just give you the minimal information that you can digest. Beyond that, they won't give it to you because you will have multiple questions when you're going to look at the large amount of data, and they hesitate. It's going to be time commitment my end to go answer all those questions, because everybody has some limit, or so that's the reason you will see there's some hiccups there. So not necessarily everybody's bad, but the thing is, the mentality that I'm going to do it myself and I'm going to show only the right thing. But on the other side, whether you're LP or GP, you wanted to know all the good, the bad, the ugly, right? Because you are in for experience, a particular experience. And if you're not gonna get that, there's no point of doing anything. Because that's what life is all about, basically, all the experience that we are creating. We are in experience right now too with you, Dr. Tyson Cobb, because this is like an amazing opportunity for us, listening to you and learning from you with your background, with your experiences, but this is all experience too. So just having that understanding is going to put you on a different trajectory. That's the way I look at it. So I'm going to ask you the question on your experience. Given your extensive experience, what are some of the common or the biggest mistake that you have seen people or investors making throughout their life cycle or the investment journey?
Yeah, so probably the most common mistake is the one I brought up earlier. They just get into a deal without really vetting it. So there's a lot of kind of shiny object, as you mentioned earlier, that's presented. So, when you look at a presentation, and you have to be asking yourself every time you look at something, why is that so, and how can it be proven? And so you have to follow everything back. And so you want to go back to the comps. Are the comps really comparables, or are they just what they pulled out so that it tells the story that they want to tell the story? So when you look at the comparables that they're using, are they the same vintage? They have the same amenities. Is it if you're not there in person and you're trying to look at it, for over the internet, which you can certainly do. You can vet all this over the internet, but sometimes you have to make a few phone calls to find out what they're actually leasing those for. And so it takes a lot of research to dig in on these things and find the red flags. And one thing I was going to mention earlier, and then I got off and forgot about it, but Cunningham has written several books, and he talks a lot about decision making. He talks a lot about thinking, and he says, when he's making a decision, he says, "What's the upside? What's the downside? And can I live with the downside?" And so I think that's a good thing to, to always put in. We were talking about diversification earlier. It's not uncommon for investors to get excited about a deal and they're like, I've got $1.5 million I want to invest. We're going to put it all in this deal. And my first response is always don't do that. Do what you want, but I wouldn't recommend doing that because, if it's all in one deal, you never know when something's going to get snake bit because you can't mitigate all the risks. You can't possibly
That's
know
true.
everything. So, I mean, just,
Mhm.
think about COVID hitting. Everybody knew that the interest rates were going to get pumped up. Uh, we didn't have any idea how high they were going to run it, how fast they were going to run it, and how long it was going to last, right? So there's just a lot of things that you don't know. Even now, I'm looking at that. We know what happened as they ran it up. Now we're on the backside. It's coming down. Probably it's going to continue to come down. Probably that's going to push property prices up. And so there's probably a lot of money to be made here. But is that a reality? No, not yet. It's just an assumption at this point. What if we're wrong about that assumption? Well, a couple things you can do. Number one, don't buy anything that's not cash flowing and can't survive if the
That's
interest
true.
rates don't change. So if
Mhm.
you're counting on the interest rates to change to make your money on the deal, which a lot of people are because it's really set and poised to make that happen. But the reality is you don't know if it's going to happen or not.
Mhm.
So what if it doesn't? Does the deal still work? Because if it doesn't, don't go into it, right? Don't
Mhm.
take that, don't take that chance. So you have to always be asking yourself those questions. When a syndicator presents a deal to you, if you basically dig in on every single aspect of what they're presenting you and see if you can make it work in your mind and then say, what if? What if it doesn't work? What if they can't hit this occupancy? What occupancy can you still at least cash flow neutral, so you don't have a capital call. So if you don't ask all those questions, and they're like, oh, we're at 98% occupancy. Well, what happens if they get a big influx of new units to the market, and what's going to happen then? So you have to ask all those questions, do all that math, and if it looks like it's pretty bulletproof, then you're probably okay. If it looks like if you're banking on the interest rates going down so that you can make money on the deal, don't do the deal. There's too much risk in deals like that. So, we were talking about partners earlier. I think you make a good point. Finding good partners is difficult. My point is we have so much deal flow now because we're in so many groups. We go to so many meetings that we just see a lot. So that's one of the things that's really changed in my life since starting to review capital and really getting involved in syndications. Is our deal flow has just exploded. So we don't really have to do deals. We get so much deal flow that we can pass a lot of them up. And just to give you an idea, we left and went to a meeting in Vancouver, left there, went to a meeting in the Carolinas, and left there and went to a meeting in Scottsdale before we even came home. And that's kind of our life right now. We go to a ton of meetings, but I love it. I mean, if I didn't love it, I wouldn't do it. But I love hanging out with entrepreneurs, love meeting new teams, looking at new opportunities, and it's a numbers game. If you're looking at a ton, you can pick out some good ones, and it's not that hard. So it's finding good partners hard. It is for most people. It's not for us because we're on the road constantly. We're talking to people literally every day. So when you have that, a huge number to select from, it's just a lot easier finding the right people. And do we know for sure that they're all going to work? No, we know for sure they're not all going to work, right? So you have to mitigate that risk. And it kind of goes back to what we were talking about earlier. Regardless of how excited you are about the deal, don't put all your money in one deal. Divide it up, find different teams, different geographic areas, different asset classes, because they're all going to go through, different cycles. So you're going to have cycles in Phoenix that are going to be different than they are in the Midwest, right? So it's a different market, different environment, and it's going to react to different levers. So try to spread all that out so that you're able to mitigate the risk of being in nothing but multifamily in Austin, Texas, right? I mean, you're gonna get beat up at some point in time. You can just count on it, right? But if you're in a multifamily in Austin and a different multifamily in, in the Midwest, and we're doing self-storage and we're doing some boutique hotel on Carolina Beach, right? I mean, we just got a lot of different asset classes, and that creates some, safety and diversification that just makes you a lot more stable.
That's true. I agree with you. Diversification is so good. And my portfolio is pretty diversified as well, just like yours. I'm not the multifamily only. I do have multiple other asset classes like industrial, self-storage, BTR. I do have a land development deals as well under my belt. So I believe in diversification, and then working with multiple operators, it gives you so much insight. I can't even tell you, because everybody has a different way of working, different style, different way, excuse me, different way of thinking, because the thinking process is so different. You will notice that when you're working with multiple people, like, oh my God, the previous operator, why couldn't he see this? Because he does not have the bandwidth, because it's thinking certain way. So what gives you that is that gives you the opportunity to have like maybe more holistic view, not just on the operators, on yourself too. And the more you learn about yourself, I think the better you are building the good relationships and seeing through people and knowing who could be your best partner going forward. So there's few questions I'm going to ask you that. I think you already answered this one. So do the deals come to you and has a team in place versus finding a deal you like yourself and then finding a partner?
Yeah, I do it both ways. I mean, we get more deal flow now just because we're in so many groups and we go to so many meetings. We get deal a lot more deal flow where the team comes to me looking to partner up. But we do find stuff and put it together and syndicate it from the ground up as well. That's less common right now just because of what we're doing. So I went from really putting in a lot of offers on property that was either for sale or off market to moving into a position where we're just going to a ton of meetings, meeting a lot of teams. And I enjoy partnering with teams for the reason you just said. I mean, you learn so much from working with different teams. And I can't even tell you how many times that I would see somebody fix a problem over here. And then 6 months later, we're having the same problem in another location. And I'm like, we just went through that with this property. This is what they did, and it worked great. And
Mhm.
it does give you a lot of insight for different levers to pull to fix problems. So
Great.
it's very beneficial to be involved in a lot of different teams.
Great. So on the next question, same person, Anthony. How many team members do you have at your company, or is it just all partners?
Boy, I don't know how to answer that question. So, we have a team of people that, help out with, investors and keep everything organized in that regard. And then on a different level, on the deal level, then we have a lot of different teams and different partners. So we're putting a development deal together right now. There's three of us that are syndicating that. Um, one of the same partners I partnered with on a boutique hotel on Carolina Beach. There were five of us that went in together and syndicated that. And some of these teams for some of these big multifamily syndications that we join are, they're huge. They're vertically integrated and have, hundreds of employees. So it's a different answer depending on what perspective you're looking at.
Great. And the next question is, what is your buy box?
Boy, that's depends on what we're looking at. One of the new asset classes that we've moved into is business acquisitions. So we have I'm putting in offers all the time myself. I've got partners that are helping to look for businesses, and we have a syndication that we're raising some capital on. That's doing a roll-up strategy on paving businesses. For that buy box, we look for businesses that have been in business for around 15 or so years, 10 at the minimum. We're looking for 15 plus employees. We like to have management structure there. I mean, we can put it in if it doesn't exist, but it takes more effort and time. So it's preferable if they have a management structure so that the owner is not completely the only bus driver, because those are the hardest to take over, particularly if the buyer wants to be out immediately. I try to do deals where we keep the buyer on board, so we're not looking for somebody that's just sick of their business that wants to move to another state. What we like to see is business owners that are tired of the business, and just want to, all I want to do is build homes, or all I want to do is, run my equipment, or all I want to do is whatever it is the business does, right? I just don't want to have to deal with all the employee stuff and the business and whatnot. We can roll in and put that structure in and solve that problem for them, and then they're happy and we're happy, and we're at a win-win. We look for about a 20% margin on the revenue. And um, other than that, it really, I mean, each asset class has a different buy box, right? And so, we're doing a triple net roll up right now. We just finished our series one on that, and we're raising on series two. And our goal with that is we're buying medical dental offices, and our goal is to have enough of those to either sell it to a REIT or turn it into a REIT, or otherwise sell it to some of the big players that are willing to write a bigger check and pay a premium for the convenience of being able to buy that portfolio already put together, right? It saves them a ton of time not having to do that. We have a couple of gas stations under contract right now with the goal of starting a gas station roll up. And it's just another triple net play. So these are owner sell and lease back type things. So they basically, the reason they want to sell those is they get their capital back. So they build everything like they want it. They sell it to us. They take that capital and they put it into another deal, and now they have two locations and they do the same thing again. They rinse and repeat. Take the capital and go buy another one, and they're doing long-term triple net leases. So these are 20-year triple net leases with 2% bumps or whatever you can negotiate. So it's so easy to do the math on those, because what I mean. You're basically just buying an income stream for the next 20 years, and in the meantime, your real estate's appreciating. It kicks out depreciation, so it helps with tax mitigation. So it's a nice asset class. It's a little boring, but sometimes it's nice to do boring stuff, because it's so predictable.
That's true. I think it's good for your portfolio. I have some of those too, industrial, bunch of them actually. And I like sale leaseback as well because that's a really good model. Like you said, the leases are so long and I kind of peace of mind. Maybe they have a little bit less returns than the multifamily, but it's more solid, less volatile. That's the
Yeah.
way I'll put it. And it's stronger deals, those ones. And being triple net, it makes your life much easy as well, if it's complete triple net, right? The absolute triple net, they call it.
Yeah.
So
Very,
I'm sorry, go ahead.
very predictable.
Yeah, it is because you can really predict where you're gonna be going. And the other thing you mentioned was the roll-up. So I was thinking in my mind, what do you think about the roll-ups in this market? Do you think is it like kind of a good solution for a lot of people to do the roll-ups now? Because I think the big investors like the institutionals or the family offices, they are looking for quality assets actually. And if the quality assets out there and it's a roll up, they're gonna be just grabbing those left and right. What do you think? This is again my perspective. So what do you think? That applicable in this market? Whatever I'm thinking.
Yeah, I mean, we're doing three right now. So we're about to do four with the gas stations. We also have one on marinas. And I love the roll-up strategy because you're
Mhm,
basically just doing the same thing over and over again.
mhm.
And the boost at the back, I mean, obviously the math has to work on each individual. So you can present two different returns to your investors. You basically have the bump that you're getting for the returns on each individual property. And then on the back end, once you've put whatever it takes, 50 of them together or 20 or whatever the number is that gives you that, you're looking for a higher multiple on the exit, right? So I mean, like the paving companies were trying to get those bought at, maybe a 3x on the average of the free cash flow, and then try to sell those on the backside at maybe a 6 or 7x. So it gives you a big bump with no capital expenditure. So it's unlike the multifamily value add play where you have to pump all the money into it, do all these remodels and so forth and so on, which is, can be unpredictable. How much of the tariffs going to change all of this? So, you've been through that. There's so many different variables involved. There's really no variables on the roll up other than you don't know for sure what the
Mhm.
market's going to be when you get there and how big the portfolio needs to be to attract the right kind of people.
Great. So let me get to the next question. I'm going to remind everybody, if you have any question, please use the Q&A box, and Dr. Anka will answer it for us live. The next question is from Carolyn Wheeler. She wants to know, can you please explain what it means to be vertically integrated?
So vertically integrated means that they basically have everything in-house. So a vertically integrated multifamily operator would have the property management in-house. So they're actually, W-2 employees that, answer to the lead syndicator. They have a, team that's doing the remodel, reconstruction, all the rehab. All of those are their employees. The other side of that fence would be if you're not vertically integrated, you're hiring a property manager and you're kind of a little bit at their mercy because it's not easy to change property managers. And it's not uncommon for them to basically tell you that they can't do whatever it is you're trying to do because either A, they don't think it's going to work, or B, they don't have time to do it, or whatever the excuse is. And so now you're in a situation where you're like, okay, well, if they're not going to do what we want to do, let's just fire them and hire another one. Okay, well, that's not always simple. It's not always that easy. So now you have to research, decide whether or not it's worth it. And in general, if you're in that position, you're better off to rip the Band-Aid off, get rid of them, and get a different one. Because I've watched a lot of teams that couldn't make a decision wind up losing a lot of money because they rode a dead horse into the ground. If they look like they're not gonna get it done, I think you basically just tell them, look, it's this way or the highway, and they either pony up or they don't, and then you have to rip that Band-Aid off and replace them. But it's, I think the teams that get vertically integrated, they hire all their own employees, they train them, they teach them how to create a culture in
That's true.
the multifamily so that the tenants love them. They love the managers, and then your occupancy grows. You can bump those rents because people love it there so much. They're willing to get the rent bumped up a little bit more, and it just becomes a solid win-win for everybody involved. Fighting with teams that don't want to take care of your tenants is a miserable place to be. And so, I think if you have the bandwidth and you can do it, if you can vertically integrate and have your employees doing everything about it, making all the decisions, you're just a lot better off.
Yeah, I think a lot of operators, when they get bigger or when they scale, they look into this kind of flywheel approach and not diversification of the asset class as well, and as well the vertical integration, so they can bring a lot of things in house. Basically, they are growing not just um, the asset under management perspective, but as a team, and also bringing a lot of things in-house to make them more robust. So moving on to the next question is from Agnieszka. Hi, how are you? Good to see you here. I love those diversified asset classes you guys are investing in, including marina acquisitions or paving companies acquisitions. So I think this is just a comment, maybe. So the next question is from Lisa. Hi, Lisa. Good to see you here. Thank you for the insight and honesty. I'm a nurse, and my goal is to teach other nurses and healthcare providers how to invest with their 401k SDIRA into multifamily deals. How do you start the conversation with your colleagues to invest?
That's specifically for multifamily.
Yes, she said multifamily deals.
Yeah. So, I mean, I think it depends on your goals. I mean, if you're looking for people to, to partner up with, um, either way, I mean, you have to start with education. So, in my case, I just show people my net worth growth with and without real estate, and then back that up with the, Tony Robbins research, and that's pretty convincing for starters. And then, okay, so now they see that this works, and they understand the background on the difference between the private deals versus the stock market, and they start to understand the advantage of tax mitigation on your net worth growth, and then you have to get them comfortable with all the terminology. What's a syndication? What's a general partner? What's a limited partner? What does vertically integrated mean? What has this team done? Why do you trust them? And it just, a list of about 100 different things that need to be kind of sorted out, and walk them through all of that so that they have a good understanding. So confused investors don't invest.
That's true.
So if they're overwhelmed or otherwise confused, which I think we're all there at times, right? Um, my advice to people is that it's okay to be a little uncomfortable, like we talked about earlier, but you want to do everything you can to try to understand everything, and turn over all the stones and mitigate as much risk as you possibly can. And a lot of that's just being in the right groups with people that can kind of help you with that. Because if you wait until you're 100% comfortable, you're never going to get it done. It's just not going to happen. So, part of the comfort you're going to get is actually doing the deals. So start off a little smaller, and find the right teams, people you're comfortable with, and invest alongside them, and then as you go through that process, you're just going to learn a lot, and you just become increasingly comfortable. But yeah, I mean, I think if you want to, pull your partners and colleagues in on deals, start with, the why, and how, and put some basis behind that, and then educate them on whatever asset class that you're going into, so that they can understand how it works, and why you believe it's a good deal, and why you trust the team, and what's their background, and it takes a little while for people to get comfortable. It's not uncommon for me, to watch people watch me for like months before they, finally pull the trigger. And as mentioned earlier, it probably took me a year before I was reasonably comfortable with a lot of this. I didn't wait that long to start investing, but um, just the terminology itself for people that are outside looking in is a little overwhelming. And, just some type of educational platform goes a long way.
That's true. I agree on that, and I think doing it yourself, that makes the difference and that creates the track record for yourself. So how I did was I started investing myself as an LP. So because you have to have the experience, right, in order to share with somebody or educate somebody. You cannot educate others without having zero knowledge yourself.
Right.
That's just like a lot of people I know that do that at different ways, different times, but you gotta have the experience with you within yourself to share with somebody, and that's what is gonna differentiate. And then for me, I think I'm kind of hands-up person. I have to do it myself and learn the hard way versus just like taking somebody's advice. Don't get me wrong, I get others' advice too, and I implement that too, but I like to try it myself. I think the best way to do is do it yourself, get your experience, and then share with others because that's your complete track record right there. Because a lot of time people say, "Oh, I am new. I do not have a track record," and I hear other people saying multiple times, "Leverage others' experience, leverage others' track record." Hey, but that's somebody else's track record. Your track record is, even if you're a capital allocator, your track record is finding the right person who has a strong track record. So by doing that, you're creating your own track record because you're finding those people, those investments that you can share with others, those you think can apply, right? So
Right.
that's your track record right there.
Yeah. Yeah, I tell people the same thing. I mean, once you've kind of developed your own story, then that's what's most important and most applicable. But until you get there, you can use other people's stories by just simply joining their team. And there's certainly nothing wrong with that because it is a team sport.
It
It's
is a team sport, and you have to be comfortable with their track record. Then you trust them fully because you're saying, okay, I vetted them. This is my track record, whether it's a first deal or 20th deal or 100 deal, and this is my track record. I vetted them, and this is their track record. But since I'm in the team, it's combined track record basically. So let's move on to the next question. I own triple net, but I invest in all the deals. How do you scale that since returns are more muted but predictable? Do you run those as JV or syndication? How do you find partners for all these deals that require millions of dollars that only a few partners cannot possibly do on their own? This is from Anthony again.
so there was a lot to unpack there. You know, the the key with the triple net roll-ups relative to the cash flow, because I agree they can get very skinny. So you have to underwrite those so that they have enough meat on the bone to bring other people in. And the way to do that is you just go through a lot of deals and you underwrite them, and they either meet that criteria or they don't. And if they don't, then you either A, renegotiate the terms, or you walk away from the deal. Because as I mentioned earlier, you can't do bad deals. And if you're doing a roll up, and with those, it's basically a evergreen fund, at least for a period of time as you're going through the roll up strategy. It's important that they don't all have to be perfect because you need to average. So for every great deal that you get, you can buy, maybe a shiny object that you overpay for just a little bit so that your average hits what your projections are. But in general, you're looking for every deal to be very close to your projections so that you hit that first projection. And then that bigger bump on the back end is when you finally get enough of them put together for the roll-up strategy, where a REIT or other big player will step in and give you a premium for the convenience of having the portfolio put together. As far as partners, it's all about being in the right groups. So when
That's
you
true.
get into if you're hanging out with groups of physicians, you're going to struggle. If you're hanging out with groups of entrepreneurs and real estate investors, there's a lot of people there that are willing to partner. And it kind of goes back to what we talked about earlier. You don't want to partner with all of them, so you have to do a good job of vetting these people.
Finding that.
And there are deals that we've done, I'll be honest, where like, okay, I'm not going to partner with that guy again. Not that it necessarily blew up, but it's like, okay, this just is not a good fit.
That's true.
So, sometimes you make money and you still don't want to do another deal with them
Yeah.
just because you
Experience.
aren't
Yeah.
okay with, maybe their communication style is so bad that you struggle to interface with your investors because the chain of communication is just not there. And so, you just better off to walk away from things that create pain in your life. And in general, history tends to repeat itself, at least to some extent. So, I mean, if you do a deal with a partner and they create pain in your life,
It's
uh,
not worth it.
yeah, it's not worth it. Find somebody else. There's a lot of great partners out there. You just have to go through a lot of options until you find them. Now, the reality is nobody's perfect.
That's
I'm not perfect. You're not perfect.
mm-mm.
So we can't expect our partners to be perfect, but you have to figure out, what can you tolerate and what can you not tolerate? What are the deal breakers?
That's
Obviously
true.
they have to be honest. They have to be transparent. For me, they have to communicate because if they don't communicate with me, I can't communicate with my investors, and it puts me in a very difficult spot.
I agree.
So, you have to figure out what works in your life and what's going to be the pain points. And it's nice if you can figure that out ahead of time. If you don't figure it out ahead of time, you'll figure it out on the fly. as you deal with partners that you wish you hadn't gotten involved with. And that's, that's a, a pain point that you won't forget, once you've done it. But, the reality is you want to learn as much as you possibly can from other people that have, learned from experience. But, what you don't learn from other people, experience is going to teach you the hard way. And you want to try to avoid that as much as you can. But, you're going to get some of that.
Yeah, no, thank you so much. So let's move on to the next question. What tools or resources do you use in your feasibility? Your own spreadsheet, third-party tool, also using AI in these efforts?
Yeah, so I love AI. It's a game changer. I'm still a bit of a novice with respect to that. I do encourage my team to dig in deep on the AI, and one of the realities of business and real estate investing and in life in general is you don't have to do it all. So if there's something that you don't like, hand that off to somebody else. Delegate that. If it's something you feel like you're not good at, you just don't want to climb that mountain, delegate it. Hire somebody to do it. So it's life's too short to spend too much time doing things you don't like, right? So, I mean, you're going to have
Right.
to do some of things you don't like, right? I mean, we're all going to deal with difficult tenants. We're all going to deal with difficult partners. We're all going to deal with, tax-related issues and bank-related issues, and the list just goes on and on and on. We're all going to get a little overweight and have to trim it back down and go through the pain of making that happen, right? But that's just life. I mean, we're just constantly, trying to, get back to on course. And the reality is, I'm a pilot myself, and we're never completely on course, right? Even a plane that's flown with an
Yeah.
autopilot, I mean, it's
Mhm.
just shifting a little bit from one side to the other. The wind will change and it blows it off course, and the autopilot corrects and brings it back over. So the reality is, we're all a little off course. The key is to just make sure that you just have little adjustments. So it's a lot easier to get your weight back if you only gain 1 pound too much than if you gain 30 pounds. Okay, if you're 30 pounds off course, now you got a problem. It's going to be a very painful endeavor, and it's going to be a slow process. And it's the same with business or real estate investing. If you're looking at KPIs like your P&L, that's a terrible KPI. You want to follow each of those levers all the way back to how many conversations do you have, or how many deals are you looking at, or whatever the metric is you're following. You want to take that all the way back to what you do on a daily basis, and that's the KPI you want to track, because that's the KPI that's going to make a difference. So if you go from 2 calls a day to 6 calls a day, you've tripled your input. And if you do that every day, it's not that painful. And by the end of the year, it's going to change your output substantially, and you won't even feel it. But it's like that example I mentioned earlier. If you get 30 pounds overweight and now you got to trim that back, it's going to be painful. You're going to feel some pain. It's going to take some time. And it's the same with these metrics. If you wait until the P&L is off, or the CPA tells you at the end of the year, you've got to write a check to the IRS for 300,000 because you didn't keep up with what was happening and make the right decisions as you went through the year. Now you get some serious dose of pain, and so don't do that. Back everything up to the very beginning element of whatever it
I
is. And
agree.
so, have your tax consultant or your tax strategist or whoever's helping you back everything up, and think about all the levers you can pull. And there's a ton of levers. So tax mitigation is the same as wealth. It's the same as health. There's a ton of different levers to pull. And if you just will be consistent with it and do it on a daily basis, it's not that difficult. But once you get way off course, trying to rein it back in, it's a chore. And it's going to create a lot of pain in your life. So if you can back all those decisions, whether it be health, wealth, tax mitigation, which is a huge part of wealth creation, You can just break it down into component parts, and it makes life so much easier.
Oh my God, I really love this takeaway, Dr. Tyson. The way you said it, finding that equilibrium or the balance is never there. You're gonna be shifting here, there a little bit, and you're gonna be doing that throughout the journey. It's not just like one time you do it, set it on autopilot and forget it. That's never gonna happen. Because that's not gonna be a good deal if you're talking about the
Right.
real perspective. Because you have to be kind of laser sharp focus to keep an eye on that and keeping bringing that back to balance, no matter what happens. So then it's going to be smooth sailing. Otherwise, there's no smooth sailing. I love that takeaway. So one last question. Um, any last advice that you wanted to give it to our audience? Look at it. We have tons of people sitting here glued to you, listening to you for an hour and a half. So you're such a magnetic personality, such a powerful conversation. So one last piece of advice.
Well, I'll go back to what we were talking about. Thank you for those compliments, by the way. Um, Go back to what we were talking about earlier. You have to have the mindset. You need to be in the networks and the groups. You got to surround yourself with the right people. And we didn't talk about this earlier, but I'll throw it in now. Surround yourself with people that are positive, and doing something in
100%.
life. Do not hang out with people that are like, oh, that'll never work, blah, blah, blah. It's okay to
Energy
lift the
suckers.
hood,
Mhm.
turn over the rocks, look for the red flags. I'm not saying, go in blindly on things, but come at life from an optimistic standpoint, because it's going to be good if you make it that way. So the mindset, you want the networks, you want to educate yourself beyond whatever it is you're doing in life right now, so that you can move to that next level. You have to take action. We talked about that earlier. And then one thing we didn't talk about that I think is important is, when you get to the point where you can, give back to people that are not as well off as you are, and change the trajectory of someone else's life, because that's going to create abundance in your life.
That's true. That's true. Thank you so much. So somebody, Carolyn is asking KPI. KPI is a key performance indicators that we use, I think, in every business, not just in real estate only. So thank you again, Dr. Kaur is such a, I would say, enlightening session, a powerful session, because I do not see any more questions. So I'm gonna say we can end our conversation over here. But your journey, oh gosh, it beautifully shows, wealth is not just built by luck, it's built through discipline, due diligence, maybe, some data, and your decision making skills and the right partners. These are all the things that you shared with us. So, for everybody, I would say if you haven't already created your financial abundance, you can always use all these. Things that Dr. Kopp shared with us, is going to be really, really beneficial for everybody to, or help you carve out or rewrite your story, basically. And in the end, also, I like to mention that I do have a deal I'm currently raising for. Is gonna actually is offering 100% bonus depreciation with good strong returns. If anybody's interested, please reach out to me. I'll put my email in the chat as well. But before that, Dr. Cobb, I would like you to share with us how can people reach out to you.
So you can find me on our website, timberviewcapital.com, and Calendly links on there if you want to jump on a call. My cell number is actually right up here, so just it's actually on the other side. Text me, don't call, because I don't answer numbers that I don't recognize. But if you text me and say, "Hey, saw you on the thing, have a question for you," or whatever, happy to engage and answer any questions. And then Tracy Rommel is our director of investor relations, so I have a little help that can help with hand holding if you need some help with tax mitigation strategies or introductions to the right people. So um, we're happy to help in that regard.
Thank you so much. And one last chance. Let me see. Oh, there's a couple more questions. No, there's only thank you and give advice. If there's any more questions, please ask right now. This is a last chance. Since I don't see any more questions, Dr. Cobb, so thank you so much again for sharing your insights and experience with us, and good luck with your book launch. My book
Thank
is
you.
coming out soon too. I will share that with you very soon.
Congratulations.
Thank you so much. Yeah, it's with the publisher. So we should be launching maybe early next year sometime. So,
Cool.
but congratulations, I'll buy your book as well. So, to everybody who's here today, joined us and listening to this and, stayed with us for, I say, more than 90 minutes. Thank you so much again. And until next time, stay inspired, stay intentional, and keep building your wealth. We'll see you next time with another awesome guest. Thanks, everyone.